Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers. For this particular video, I'll be considering the time period from 11th to 17th of February 2019. And the articles that I've taken up will be from newspapers such as Business Line, Hindu, Business Standard, Indian Express, Live Mint. So let's start this particular discussion. The first article is related to RWS and Tier 1. Now, this particular article had appeared in Business Sign. These two terms are very important from the perspective of the UPSC Prelims 2019. Because from the last couple of years, UPSC has been focusing on one of the basic concepts in the banking sector, which is referred as Basel Guidelines. The Indian banking sector is in the process of implementing the Basel Guidelines now. And under the Basel Guidelines, the two very important terms that you will come across is one, RWA, that is a risk-weighted asset, and the second one is Tier 1. Apart from this, one other term which is very important, please go through this particular term, which is called as CET1, Common Equity Tier. So let's look at these two particular concepts first before looking at the article. What is RWA? A bank will issue loans to borrowers in the market. There would be multiple types of borrowers. It could be a borrower that is government, the corporates will borrow, the households will borrow, that is a retail loan segment, etc. So basically, the bank giving loans to these kind of borrowers in the market will face a certain risk. What is a risk? What if the borrower doesn't repay the loans to the bank? This kind of a risk is faced by any kind of a lender in a market. So under the Basel Guideline, it basically states that to each kind of a borrower in the market, the bank should allocate a certain risk. And the loans which are given by the bank to the borrowers are assets for the bank. And such a risk allocation for the asset is referred to as risk-weighted asset. I'll repeat the statement. Banks will give the loan to the borrowers. There will be different type of borrowers or profiles of borrowers will be present. To each of the types of borrowers, certain risk weightage will be associated. This kind of a risk weightage given to assets of the bank, which are nothing but loans, is called as risk weighted assets. Now, another Basel Guideline, basically RBI states that if a loan is given to the government, then the risk weightage for this kind of an asset will be 0%. In case of the retail loans, such as loans for housing, if the loan value is up to 75 lakh rupees, the risk weightage will be lesser. If the loan value is more than 75 lakh rupees, risk weightage will be higher. Whereas in the other side, that is the commercial real estate, if a loan is given, the risk weightage will be 100%. So this is the concept of a risk weighted asset. Now please understand, higher the risk weightage given, the bank has to maintain certain capital. In simple terms, under Basel Guideline, it states that a loan which is given, certain risk weightage will be given, which basically means that there's a probability that certain part of this may go bad. That is, the bank may not get this particular money back. So to make up for the losses in these kind of loans, the banks are supposed to maintain certain capital. So in simple terms, higher the risk weightage, there's a very high probability that losses will be high. And to cover for this particular losses, capital maintained should also be higher. In simple terms, higher the risk weightage, higher should be the capital maintained. So this is a basic concept of a risk weighted asset as well as the capital that has to be maintained to cover for the future losses. What are the concept of a Tier 1? Under the Basel Guidelines, there is a concept of a capital adequacy ratio. One of the components of a capital adequacy ratio is a Tier 1 capital. There are two types of a capital in the banking sector. One is called a Tier 1 capital and the other one is called as a Tier 2 capital. Please understand, since the term Tier 1 capital is mentioned in this particular article, what is Tier 1 capital? Basically, the owners or promoters' equity is one type of a Tier 1 capital. I'll repeat it. The owners or the promoters' equity is a component of a Tier 1 capital. Apart from the promoters' equity, there is also a component called as the reserves, that is undistributed reserves. Both of them are very important components of a tier 1 capital. Now, what is a promoter's equity? Any investment that is done by a promoter in that company for which he earns a certain shares, it is called as a promoter's equity. For example, if Government of India goes for recapitalization, what happens under this? Basically, Government of India invests or gives money to a bank, and in return, equity will be given to the government. But government is already the owner of this particular bank or majority owner of this particular bank. So this becomes a promoter's equity. So please understand, risk-weighted assets as well as tier 1 capital are very important from the concept of a Basel. Please read about these particular two concepts. Now, what is mentioned in this particular article related to these two terms? Basically, the article states that in the recent times, the public sector banks have worked towards a reduction of a risk-weighted assets. In what manner or in how much percentage the risk-weighted assets have declined? The article says that between September 2017 to December 2018 quarter, the risk-weighted assets of the public sector banks have fallen in the range of 15 to 20%. And not only this, in this particular fiscal year itself, that is till December, the risk-weighted assets also have declined. And between January to December, the risk-weighted assets have declined in the range of 6% to 13% in case of public sector banks. Now, one of the reasons which has been cited for this particular decline in the risk-weighted assets is that the banks are focusing lesser on lending to the risky areas or risky borrowers and are redistributing or basically diverting these kind of loans to safer borrowers or the borrowers where the risk-weighted assets are comparatively lesser. So basically with this, the risk-weighted assets has declined. And not only this, on one side, the Government of India is infusing the capital into the banking sector, and on the other side, the risk-weighted assets are coming down, as a result of which the tier 1 capital of the banking sector has increased. And with increase in the tier 1 capital, it is considered to be a beneficial feature of the banking sector. Now, apart from this, another very important point that has been mentioned in this particular article is related to the Monetary Policy Committee announcement. Very recently, in the concluded MPC, it has been announced that the risk-weighted assets in case of a bank giving loan to NBFCs will be tweaked, or the guidelines will be tweaked. Now, what tweaking or changes are they mentioning here? Basically, earlier, whenever a bank will give a loan to NBFC, that particular loan is an asset to a bank. Obviously, there has to be a certain risk weight allocation on these particular assets. Earlier, the risk weight allocation was very higher. And whenever the risk weight allocation is higher, the bank has to maintain a certain capital on the side. Obviously, because Basel Guidelines says. So basically, what RBI now says is, if an NBFC is rated, there will be a different risk weight allocation for these particular loans. And if it is unrated, the risk weightage for these particular loans or the asset will be 100%. In case of the rated NBFCs, if it is rated at AAA, then the risk weight allocation will be at 20%. If it will be rated at, let's say, BBB, the risk weight will increase to 100% and so on and so forth. So basically, this is another very important announcement that has been done by Monetary Policy Committee. Now, what is the impact? Various experts have stated that with this tweaking or changes that will be introduced in the banking sector, the banks will be left out with more than 1 lakh crore rupees worth of capital. That is, rather than having to keep aside this much amount of a capital, now they will have this particular option of either lending it in the market or using it for some other purposes. That is the importance of tweaking the risk-weighted asset guidelines for bank giving loans to NBFCs. So these are some of the very important points which have been mentioned in this particular article. The next article is related to the deficit problem faced by the government. Now please understand, whenever the union budget is presented, we basically say that the expenditure side is higher than the revenue or the receipt side. In simple terms, government is proposing to spend more compared to its earnings. Now, to fill this particular gap between the excess expenditure and the receipts, the government will propose to borrow or raise the money from the market, or else even it can propose to borrow from some of the institutions. What this particular article discusses is, over a period of time, rather than approaching the market to borrow money from, the government of India is raising a lot of money from other sources. The article quotes that for the fiscal year 20, the budget for which was presented very recently, the government has proposed to borrow around 18.5% of its fiscal deficit from NSSF, National Small Saving Funds. And this particular borrowing from NSS has increased over a period of time. That is, in the fiscal year 14, it was just 2.5%, which by fiscal year 17 has a balloon to 12.6%. And for fiscal year 20, this has been further increased to 18.5%. And apart from this, NSSF has already invested more than 1.3 lakh crore rupees in the form of loans given to Food Corporation of India. So basically, these are some of the figures which have been quoted in this particular article. Now, what is the implication of this? What are the benefits or the positive outcomes from such measures taken by the government? One, the government of India need not have to go to the market always. It simply means that there are other sources from which government of India can raise money. Second, it will lead to diversification of the borrowing, which is always beneficial. Third, please understand the connection between the government borrowing as well as the private sector borrowing. Let's say in the market 100 rupees is there, just hypothetical situation. If government of India also wants this 100 rupees and the private sector also wants this particular 100 rupees, this basically leads to increase in the interest rate. In simple terms, when government of India demands more money from the market in the form of a borrowing, and private sector is also demanding as usual money from the market, the interest rates in the market are going to increase. And this particular increase in the interest rate, if this happens because of a higher borrowing done by government of India, it will be a negative outcome from the private sector perspective. Because private sector says, since government of India is borrowing more, I am forced to pay a higher rate of interest. So basically what will happen when government of India diversifies its borrowing? The pressure on the private sector to pay higher rate of interest will come down. I can understand this particular statement. Since government of India, rather than borrowing only from the market, is basically saying, I will borrow from, let's say, NSSF now. So this particular demand from government of India for this 100 rupees will come down. Only private sector is left out in the market for borrowing now. The interest rate raising will not happen, or the rise in the interest rates will not take place compared to the earlier situation. So the private sector will benefit from this kind of a borrowing. So these are some of the benefits that you can expect whenever the government of India does this kind of a borrowing. But having said so, there are certain concerns which have been raised by various experts. What are these particular concerns? One, the rate of a growth of this kind of a borrowing is alarming. That is, in the year 2019 and 2020 itself, compared to the earlier years, the growth has been 8.2%. That is, government of India borrowing from NSSF has increased by 8.2% compared to the previous fiscal. This particular number is alarming. And second, the experts state that NSSF is basically pooling the funds from the middle income or lower income households. And rather than investing in any other security, they are investing or giving loans to government of India. But this particular loan will entail certain interest which has to be given by government of India in the coming fiscal. So basically there is an interest burden on the government of India for borrowing from NSSF. So these are the two concerns which have been raised by various experts, which have been quoted in this particular article. The next article is related to the CAG report with respect to IGST distribution. Now please understand, under the concept of a GST, we will use a term, the concept of a dual GST is present. What is this concept of a dual GST? Whenever, let's say, 10% GST is imposed on any kind of a transaction or a sale of a product, it has got two components. One is CGST, central GST, and the other one is SGST, state GST. And out of 10%, 50% will be in the form of SGST, that will be 5%, and CGST will also be again 5%. So basically, whenever GST is applicable, half of this, that is 50% of this particular GST rate will be in the form of CGST, and 50% of the GST rate will be in the form of SGST. Now, this particular concept of a GST divided into two equal parts is only applicable when the transaction or the sale of a product is happening within the state, that is intra-state. What happens when the product is manufactured in one state and crosses the boundary and is sold in the second state? In this particular situation, under the concept of GST, IGST is applicable. And again, the concept of IGST is nothing but the rate of a CGST plus SGST. Then why do we use the term IGST, that is integrated GST, rather than just using GST in this particular situation? Please understand, whenever the transaction or the sale happens within the state, that is intrastate, the SGST component will go to the same state where the production has happened. Obviously, because produced in, let's say, Karnataka, sold in Karnataka, SGST component will go to which state? Karnataka state. But when the production happens in Karnataka, sales happens in, let's say, Tamil Nadu, please understand, in case of a GST, the SGST component will go to the state where the consumption of the product happens. I can understand this. Where the consumption of the product happens, the SGST component will go to that particular state. That is the precise reason GST is also referred as destination based tax, or else it is also referred as a consumption tax. That is a very important difference between GST as well as the VAT system. Earlier, under the VAT system, the state where it was produced used to take up the state component of the tax, that is state VAT. Under the concept of a GST, where it is produced, it doesn't matter. Where it is consumed, that particular state will receive the SGST component. So that is a basic difference between having a transaction or a sale of a product within the same state where it has been manufactured, compared to a transaction or a sale wherein goods is produced in one state, sold in another state. Now, whenever IGST is collected, I've already mentioned this, half of it will go to the central government and remaining will go to the state government. Now, please understand, out of the undistributed IGST, now some of you will ask me a question, if 50% goes to the center and the remaining 50% goes to the state, then where is the question of undistributed IGST? Please understand this. Until now, what I have basically stated is product manufactured within India and sold within India. But what if the product is manufactured in India and sold outside India or in a foreign market? What if a product is manufactured outside India and sold within Indian market? There also GST is applicable. So basically here also IGST is applicable on certain exports and certain imports. Please understand, in case of exports, the basic concept is pay IGST and we will refund it later. I can understand this because we want to promote more exports, we will have to keep the taxation rate to 0%. But rather than having a follow-up of a policy of a zero taxation rate or a zero rate of a tax on exports, what Government of India says is pay the GST, we will refund it to you. But basically understand this, apart from the GST collected on interstate sales, there is also GST collected in other forms. So basically out of this, whatever is undistributed, 50% has to be given to the central government and remaining 50% has to be given to the state governments. And this particular 50% that is given to the central government will basically go and be part of the tax revenues collected by the central government. And out of this particular tax revenues, again 42% has to go to the state governments. Why? Because of a recommendation of 14th Finance Commission. So this is how the IGST will be distributed between the central government and state government. Now, what this particular article discusses? CAG has basically found out that in the financial year 2017 and 2018, around 1,76,000 crore worth of IGST was undistributed. And the Government of India has decided to distribute around 68,000 crores. I'm just rounding it off. 68,000 crores to the states. What CAG says is, this particular 68,000 crores accounts for only around 38.5% of the undistributed IGST. Whereas the government is supposed to distribute the 50% of the undistributed IGST to the states. So the CAG report basically states that the Government of India is not distributing this particular IGST as per the guidelines which have been set up under the GST Act. That is one very important finding which has been given by CAG in this particular report. Apart from this, another two very important findings in this particular report are, one more, that is the auditor says that the Government of India has collected a huge amount of taxes in the form of the cesses, in the form of, let's say, education cess, and the amount is around 94,000 crore rupees. But this particular amount has not been used up for the right purpose. What do you mean by right purpose? Whenever a cess is collected, the concept is simple. The government imposes a cess with an objective in the mind. That is, they want to achieve certain objective. To achieve this objective, they will impose a cess and collect the money. For example, from the last financial year, we have started collecting education and healthcare cess, which is 4%. So basically, this particular cess is collected with an objective to be achieved in the mind of the government. What this CAG report says is, the government has collected a huge amount of revenue for education purposes, and the money that has been collected is 94,000 crore rupees. And the government has not used this particular money for the right purpose. That is the second very important finding. And the third very important finding is this. Various ministries and departments have saved around 2.5 lakh crore rupees on account of a reduced expenditure. That is, they were allocated the money, but they have spent lesser than whatever has been allocated. And the saving because of that is how much? 2.5 lakh crore rupees. What the CAG report says is, in the first place itself, the allocation should have been much better or much efficient, because many of the times some of the ministries need higher expenditure, but the allocation is lesser than what has been demanded by this particular ministry. And for the lack of funds, this particular ministry may curtail the implementation of certain welfare schemes or certain programs. So on one side this is happening, and on the other side you have allocated more than what is required for these particular ministries or departments. So these are the three very important findings of this particular CAG report. The next article is related to GST. Now, please understand, it has been more than 2 years since the implementation of GST, and with the implementation of GST, we have already reaped certain benefits from this particular taxation structure, such as multiplicity of indirect taxes has been reduced. I'm saying reduced for a simple reason. Even today, there are other indirect taxes apart from GST. The interstate movement has become easier. The transportation cost related to these particular goods has reduced over a period of time. And we have also brought in huge number of the suppliers or the manufacturers under the taxation ambit. So we have reaped certain benefits from the implementation of GST. But having said so, some of the experts have already pointed out that even today, that is after the 2 years of implementation of GST, there are certain teething issues which are plaguing the idea of a GST in India, such as online filing of returns, the concept of a e-way bill, the tax evasion that has been happening under the ambit of a GST, the monthly filing in many cases, the online invoice making for every transaction that is conducted, and even today some of the goods are not under the ambit of GST. This article pegs that 1/3 of GDP of India is not under the ambit of GST. So basically on one side certain benefits have been derived, and on the other side even today there are certain issues which are plaguing the implementation of GST. What this article says is, go back to the original discussion about the GDP. What was promised to us when the GDP was about to be implemented? The promises that were given to the stakeholders in the economy by the government was, one, with implementation of GST, the GDP is going to increase by 1.5% to 2%. That was one promise. Second promise was, with implementation of GST, the inflation is going to come down. And third one, the revenue buoyancy. That is, with implementation of GST, the taxation revenues, specifically indirect taxation revenues, which will come under the ambit of GST, will increase by 14% year on year. That is, from one year to the next year, the revenue collection is going to increase by 14%. And the promises are made based on certain assumptions. That is, the GDP will increase because of increased efficiency, such as transportation, input tax credit, and reduced prices in the market, which will lead to higher production as well as exports. Second, inflation would come down because of elimination of a cascading effect. Third, revenue buoyancy will obviously increase because of a higher production, bringing more producers as well as suppliers under the ambit of GST. So these were the three original promises which were made to the stakeholders by the government before the implementation or while they were pitching for the implementation of GST. Now it has been found that these particular promises are yet to be met. GDP has not increased to the extent that was promised. Inflation, though, has come down, is under 2% as per the latest numbers. But please understand there are various other factors which are affecting inflation rate. For example, one of the reasons the inflation is very low is because of food inflation. And another reason is a decline in the crude prices. And with respect to revenue buoyancy, the promised revenue buoyancy was 14%. So far, it has averaged around 8%. So basically, this article says that even the original promises are yet to be met. So what has to be done in the coming days so that the situation improves with respect to implementation of GST? Some of the recommendations which have been given under this particular article are: one, rather than having multiple slabs, bring the standard slab to 12%. I'm using the term standard slab or standard GST. What is the meaning of standard GST? Standard GST basically means under which taxation rate majority of the goods will be taxed. That rate is called as a standard rate. Kelkar committee had recommended a single rate of a GST, that is 12%. This article says bring 12% GST standard rate. This will lead to what? That is, lowering the GST will lead to higher compliance. Higher compliance basically means covering more or bringing more suppliers as well as suppliers under the ambit of a GST, and will lead to revenue buoyancy. That is the first recommendation. Second recommendation is, out of this particular 12%, keep aside 2%, which will be given to the local governments. That is the third tier. This particular recommendation was given even under the Kelkar committee, but this will require a constitutional amendment. But nevertheless, this is a second recommendation. The third recommendation is to bring all the exempted goods under the ambit of GST. Presently, there is a set of goods which are not covered under the ambit of GST. This article says bring all of these particular goods and services under the ambit of a GST so that the revenue buoyancy will increase. Fourth and very important recommendation which has been given is this. Presently, when any exporter exports the goods to the foreign market, the government collects IGST and later refunds it to him or rebates it to him. But please understand there are various constraints related to this particular mechanism. For example, what if this particular refund gets delayed by, let's say, 2 or 3 months? Already one of the very concerning feature of exporters is they work on very short availability of a capital. And whenever this kind of a capital is stuck up with the government in the form of delayed refunds, the exporters are forced to borrow from the market, which again entails a rate of interest. So what this particular recommendation says is, rather than following a mechanism where exporters will pay GST and again they are refunded with certain time period or a lag period, do not impose a GST in the first place. Just zero rate the exports. So basically this will promote certain exports or it will promote availability of the capital for the exports, which is beneficial for this particular sector. So these are the 4 recommendations which have been given in this particular article, so as to ensure in the coming days GST will be implemented with lesser problems. The next article is related to some of the issues the PM-KISAN scheme will face with its implementation. And please understand, very recently in the announcement of interim budget, the finance minister has announced a cash incentive or a cash transfer scheme for the farmers, specifically small and marginal farmers, that is PM-KISAN, under which annually 6,000 rupees in 3 equal installments will be transferred into these particular households which practice small and marginal farming. Now, in the previous week analysis also, there was one article which basically discusses certain issues or the problems that this particular implementation will be faced. Now, even in this particular article, the other issues are discussed with respect to the problems of implementation of such a scheme. Before looking at the problems, the article basically states that in the last couple of years, despite having around 50% of the workforce in the agriculture sector as well as allied activities, the earnings of these particular households has not been constant, or in simple terms has been very volatile. This particular volatility is because of the ad hoc policies of a government of India in terms of exports and imports, the non-efficient functioning of the APMCs or inefficient functioning of APMCs, the variation in the monsoon, so on and so forth. As a result of this, you can see that the agriculture sector, the growth rate has not been uniform. In the last couple of years, the growth rate in the agriculture sector has varied between 4% or 4.9% to negative of 0.2%. So basically, the agriculture sector has not had uniform or sustainable growth, and on the other side, the farming community is also facing the income issue. In this particular context, the government of India has announced PM-KISAN scheme. This particular scheme will face a certain implementation issues. What are these particular issues? Let's have a look at it. First point this particular article raises is, on one side, the Rangarajan committee states that the poverty line in case of India will be rupees 32 per person per day in case of rural India, rupees 47 per person per day in case of urban India. In simple terms, to sustain a single day, a person living in rural India needs to spend at least 32 rupees, and the one who lives in urban India needs to spend at least 47 rupees. What will happen if they don't have an expenditure at least of this particular value? They will be considered as a BPL category, or they will be considered as the people who will fall in the below poverty line. So basically, this is the minimum standard that is required to sustain a single day. Now, what has been given in this particular article is, out of the total allocation done for the farmer household annually has been watered down to per day allocation. And this author basically states that per day, the allocation under this particular scheme comes at around 17 rupees. In simple terms, this doesn't even meet the basic criteria to sustain a single day's existence. So the author says that in the coming days, whenever a new scheme or any other scheme is announced, it must at least take into consideration what is the sustenance level as per the recommendation of these particular committees. The author also mentions the Raitu Bandhu scheme, where the allocation is much higher compared to the PM-KISAN scheme, that is under Raitu Bandhu scheme. Per farmer, 4,000 rupees per acre is given without a higher limit or a higher ceiling. And even in case of Kalia scheme, 5,000 rupees will be given for farmers for 5 seasons. So basically the allocation in the other two schemes are much better than what has been allocated under PM-KISAN scheme. That is one issue which has been raised. The second issue which has been raised is the issue of inflation. The author basically cites an example of the cash subsidy which was given in Rajasthan for kerosene. No doubt there are various advantages that are associated with the cash transfers. No doubt related to that. But please understand what will happen if the cash subsidy or cash transfers are not indexed to inflation. This particular scheme which was implemented in case of a kerosene subsidy in Rajasthan, later was found that the cash subsidy was insufficient to buy kerosene on later date or in a later period. For a simple reason, cash subsidy transferred will remain constant, whereas the prices for kerosene will keep on increasing. As a result of this, the cash transfer was found to be insufficient to buy the kerosene in the market. That is the second issue. What is the recommendation then? Recommendation is index the cash subsidies or cash transfer to local inflation rate, so that whenever these particular products prices will increase in the market, the beneficiaries will have sufficient amount to purchase these particular goods or services in the market. That is the second point which has been raised in this particular article. Apart from this, with relation to this particular idea of a cash transfer itself, a Niti Aayog report has been mentioned in this particular article. If a question is asked in the mains, if possible, please mention the observations in this particular Niti Aayog report. What does this particular Niti Aayog report mention? The Niti Aayog report was conducted in evaluation of a cash transfers done for food subsidy. This particular Niti Aayog report basically found that with respect to the cash transfers are done in 3 of the union territories to implement Food Subsidy Act, around 50% of the people who were supposed to receive a certain amount of cash under this particular scheme received lesser cash than what they were entitled to. And around 17% of the beneficiaries received more than what they were entitled for. And around 40% of the benefits or the cash transfers have been done to certain beneficiaries, but it is not possible to identify whether it has reached the right beneficiary or not. So this has been the 3 findings of the Niti Aayog report with respect to the cash transfer done to implement food subsidy in 3 of the union territories. The third point which has been raised is related to beneficiaries itself. This article basically states that since the land titles are not clear, not updated in India, identification of beneficiaries will be a challenge. Even other articles related to the implementation of PM-KISAN have pointed out this particular challenge which will plague the implementation of this scheme. Now the central government has asked all the states to update the land records by March. But please understand, in the state of Telangana, where Raitu Bandhu scheme was implemented, they took around 3 months to update the land records. Though the central government has asked the states have already raised an issue saying that in a shorter time period or in such a short time period, it is not possible for them to update all the land records. That is another issue. Fourth point, the article says that as of now, there is no clarity or there is no framework related to implementation of this particular scheme. For example, what if there is a redressal or a grievance which has been raised? The grievance redressal mechanism has not been laid out under this particular scheme. Even today, the grievance redressal under Manrega is found to be very difficult. Now, what kind of a grievance redressal will be done under this particular scheme? It is yet to be seen. So, these are some of the very important points related to this article. So these are the various articles. Now let's have a look at some of the important questions. Question number 1. Consider the following statements. Under Basel III, the banks will have to maintain a capital conservation buffer of 3%. Now please understand the concept of a CCB again comes under the concept of a Basel Guidelines, under which each of the bank will have to keep aside 0.625% of risk weighted assets per annum or per year, and this has to be done consecutively for 4 years ending 31st March 2019. So 1 year 0.625, for 4 years it will be how much? 2.5%. But please understand, very recently RBI has given certain relaxation. This relaxation is rather than having a deadline of 31st March 2019, this has been shifted to the fiscal year 2020. But nevertheless, the important term or the number that you need to look at is 2.5%, not 3%. So under Basel III, banks will have to maintain a capital conservation buffer of 2.5%, not 3%. Second statement, loans given bank to the government will have a lower risk weight compared to a loan given by bank to a retail borrower. Obviously, yes, I've already mentioned this. Loans given by a bank to the government will have a risk weightage of 0%, whereas for the retail borrowers, the risk weights will vary, but obviously it will be more than 0%. So the second statement is true. So the right option will be option 2, only 2 is correct. Question number 2, which of the following are the measures taken by the government to bridge the deficit? Borrow from NSSF, we have already seen this. Borrow from the market, yes, the Bharat 22 ETF, that is exchange traded funds. Now please understand, this Bharat 22 ETF is also nothing but borrowing from the market itself. So 1 is correct, 2nd is correct, as well as the 3rd is correct. So right option will be option D, 1, 2 and 3. Question number 3, consider the following statements. All the cess collected under GST will be transferred to the consolidated fund of the center. Now please understand, the cess that will be collected by the government on certain commodities or goods such as cigarettes, tobacco products, so on and so forth. That particular cess will be used to pay compensation to the states. What kind of a compensation? Whatever is the GST revenue collected by the states, if it falls below the expected revenues, then this particular amount will be paid in the form of a compensation. To pay the compensation, Government of India imposes cess and collects along with GST. But please understand, this is not applicable on all the goods. Specific goods will be imposed with GST as well as cess. So all the cess collected under the GST will be transferred to the consolidated fund of the center. No, this is wrong. All the cess that will be collected will be in a fund from which compensation will be given to states. Out of the remaining, 50% will go to the central government and remaining will go to states. So the statement is wrong. Second statement, the GST cess is imposed on all the products that are covered under the ambit of GST. Wrong. I've already mentioned this. So the right option will be option D. Both are wrong. Now, 2 descriptive questions. Question number 1. India not only has employment problem but also has employment data problem. Elucidate. Just expand over this particular statement. Second statement. Subsidies are a politician's delight and economist's nightmare. Discuss. So these are some of the very important MCQs as well as descriptive questions related to the articles which I've discussed earlier. Thank you. Have a good day.